natural language processing as a core discipline has made fundamental progress over the last 5 years particularly. However, when we come to the application in financial contexts, this is a bit different game. Hi, I'm Max Ahrens, and the paper I'm talking about today is called Mind Your Language: Market Reactions to Central Bank Speeches. We analyze central bank speeches to see if and to what extent they have an impact on financial markets. So central bank speeches have been mostly neglected from the analysis, even though this is a communication medium that central bankers use throughout the year to communicate with the markets. And we think our hypothesis was that a lot of vital information can be in these speeches, and to understand how effective monetary policy is and monetary policy communication, you cannot neglect these speeches. Therefore, we created a new data set where we collected more than 3,000 of these speeches from US central bankers over the last 20 years. And used novel methods from machine learning and specifically natural language processing to analyze to what extent these speeches by central bankers contain any new information for the markets, what we call a news shock, and to what extent markets react to those, particularly with a focus on volatility and tail risk measures. So we had an initial training and validation set in which we used central bank internal documents where central bankers discuss changes in forecasts, particularly on inflation, economic growth, and unemployment, where we then have the machine learning methods learn a mapping from central banker forecast to the language they use to describe these forecasts. And when completed, we have a very good understanding of what models do quite well in this exercise and other models fail. And the best models we used for this, we then continued to our application on the analysis of the central bank speeches. We made sure these two time periods also did not overlap in time, so there's no data leakage in the time dimension. And then applied these trained models to find exactly these signals on changes in either inflation, economic growth, or unemployment in central banker speeches. So the key findings are that independent of whether these news shocks are positive or negative, markets react with increased volatility and uncertainty to it. And what's also interesting is that we use the time series and split it into times where we were in normal economic regimes, that is, the inflation rate is close to target, economic growth is close to historic averages. And then we looked at what we called abnormal regimes, so where you have really high or very low inflation rates, or abnormally high or low economic growth. And we see that in these abnormal times, markets tend to listen a lot more closely, if you wish, to these central bank news. So the markets tend to listen more closely in these abnormal times to the same news intensity compared to the normal economic times.